Whoops, I did it again. Well, the Fed cut the federal fund rate 0.25% as expected. But the problems came in when the question and answer session began. And Jerome Powell, he put his foot in his mouth again. I had several of my clients call me up and say, hey, Pat, are we in the fives yet for interest rates? The Fed just cut the federal fund rate by 0.25%. And unfortunately, I had to tell them, hey, to the Real Estate Show with Pat Lopez, where we talk everything real estate. For this show, we're going to talk about the Fed Fund meeting on October 29th with Jerome Powell. Whoops, I did it again. Isn't that a song by Britney Spears? I think so. Well, here we go. He put his foot in his mouth again. Also, we're going to talk about the improving spreads. So let's jump right into it. And what happened on October 29th? Well, the Fed cut the federal fund rate 0.25% as expected. But the problems came in when the question and answer session began. And Jerome Powell, not once, but twice, turned around and said it is not a foregone conclusion that we will cut rates again on December 10th, which is the next federal fund meeting. Now, he talked about with the government being closed and not getting all the financial data. So it's a little foggy out there. You know, I guess maybe London fog, I don't know, are we in England? But anyway, he's saying we don't know for certain. We need the data to come in. Well, guess what? Markets reacted where interest rates went up. And the reason why I'm talking about this, I had several of my clients call me up and say, hey, Pat, you know, are we in the fives yet for interest rates? The Fed just cut the federal fund rate by 0.25%. And unfortunately, I had to tell them, hey, the interest rates, the mortgage interest rates actually went up. Now, the market, once again, was anticipating there was a 96% chance from the CME group, which is the Fed watching tool, a 96% chance that they were going to cut the rate on December 10th. And now there's only a 67% chance of them cutting rate. Once again, just because of the question and answer session by Jerome Powell. This is the second time this happened, because the last federal fund meeting, the exact same thing happened. He started flip-flopping like a fish out of water, and interest rates went up as well. So it wasn't all bad news when he started talking. He did talk about a quantitative tightening. They were going to end it. And what is that? Well, the Fed let the mortgage-backed securities, the treasuries, run off, meaning once they came to maturity, instead of them repurchasing it, they would send it out to the open market, and then people would buy it. Now, why is ending that and them not letting the runoff go to the open market and them repurchasing it? Well, it's simple. There's now less debt. There's less of these treasuries and bonds going out in the market. So if there's less of something, you know, then you get, you know, more of a demand, law of supply and demand. So that is good, which is going to cause, or is causing, the spread to narrow or come down a little bit. And now, what is a spread? What the heck are you talking about, Pat? Well, there is a mortgage spread in between the 10-year treasury and the mortgage-backed security. Two different things. Mortgage-backed securities is once you get the loans, everything's bundled together, goes to Wall Street, and it's sold as a mortgage bond or a mortgage-backed security. Well, there is always a spread, and if we look historically over the past 50 years or so, you are looking at the historical spread to be 1.8. Now, 1.8. Well, if you look at where the Treasury is right now, the 10-year Treasury, we're at 4.1. So if you add those two together, if we went back to historical norms, you would be looking at a 5.9% interest rate. So just by the spread continue to improve, interest rates can naturally, you know, come down. The mortgage interest rates can naturally come down. So we don't need the 10-year Treasury to really drop too much more to get into the fives. We don't need the Fed to, you know, cut rates, dramatically more. Just the spread improving will get us to that point. And they are starting to improve. Now, why did they sort of get out of whack? In 2023, they really were out of whack. The 10-year Treasury went up to 5%. The spread was over 3%, like 3.25. We had interest rates at 8.25%. And that all happened because there was a bunch of banks, not a bunch, but several banks that who went insolvent, and the Federal Reserve had to come out and bail them out. Silicon Valley Bank, Republic First, there was several of those banks happening, and then that's where that spread really got lopsided. Now, the past year, the spreads have been getting better and better and better. Hopefully, we can get to that historical 1.8, somewhere in that range, so we can see naturally interest rates coming in a little bit better. Now, Realtor.com, their chief economist turned around and they are predicting, or she is saying, that these rates are going to come next year in line where we should see really low 6s or high 5s. And that's pretty much where we're at right now. We're in the low 6s. We were really on the edge of getting into the 5s because we had rates at 6%, 6.125, 6.25. Now they bumped up a little bit to 6.375. So we gave back about 0.25%. And once again, that's just because of the comments by the Reserve Chairman, Jerome Powell. So spreads are getting better, which is a good thing. Hopefully, the term of Jerome Powell is coming to an end. President did also, or Scott Bessent suggested 5 names for the new Federal Reserve president. So they're talking about having an announcement in December for that. And starting December 1st, the Fed's going to stop the runoff. They're going to buy back the treasuries and the bonds that come to maturity, so there'll be less in the open market, which will be a positive thing. Now, I'm going to end things off with Realtor.com also came out with a really interesting article, and you tell me what your thoughts are. The average age, they're saying the average age of a first-time home buyer is now 38 years old. If we go back 20 years ago, it was like 28 years old, 20 years ago. So why are first-time home buyers waiting longer to purchase their first home? I mean, there's a dramatic difference between being 28 years old and being 38 years old. Well, I think there's 3 different areas that we can look, and I want your feedback. Tell me what your thoughts are as well. I think number 1 is just culturally, like, what are younger people thinking today? And I think a lot of them are going on vacations. They're going 2-3 vacations instead of saving money for a house. I think also just that total mindset of, live now as opposed to later. They also go out in groups. Like, you'll have a group of 5 guys and 5 girls. They'll go out, as opposed to when I was younger, many, many moons ago, I might add. Anyway, when I was younger, I was looking to meet a girl, get married, have kids, buy a house. I mean, it was, I think it was more narrowly focused when it came to that. So I think mindset culturally, I think that's a little bit different. I think also rents. Rents are a lot lower in certain areas, and I think most areas, than what it costs to buy a home. So if it's costing you $1,500 to rent a house or an apartment versus it's costing $2,000 to $2,500 to buy, many people say, you know what, let me just rent, let me save the difference, and I'll put the money in the stock market, whatever, and then in turn, I'll buy a little bit later on. So I think that could be it, but I think ultimately, my once again, personal opinion would be that it's the affordability. Since 2000 to 2005, we had 40% home appreciation. That's pretty dramatic, 40% home appreciation. So that means a lot of these people, first-time home buyers who are buying, they just don't have the money to be able to do it. They can't afford that house. They may be pre-approved for $250,000, but they're looking, the homes that they like are $300,000, $350,000. So they just can't reach it. So it's taking them longer to save and save to be able to do it, or it's taking them longer to saying, you know what, I have to meet somebody, and now it's a dual income. So where, boyfriend, girlfriend, husband, wife, whatever the case may be, both incomes are coming together to be able to purchase that home. So tell me your thoughts at realtor.com, why home buyers or first-time home buyers are taking longer to purchase their first home. Give us some feedback as far as that's concerned. Well, that's the Real Estate Show with Pat Lopez. Be sure to follow the show on Facebook and Instagram, and of course, YouTube, the Real Estate Show with Pat Lopez on YouTube. That's where this show is going to be airing. Also, give me some likes. Really helps out the algorithm, and of course subscribe. I'm trying to reach that 50,000 subscribers. Once again, that really helps me out as well. So I hope you enjoyed the show, and